It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. With me today, Matt Hawkins, founder and managing partner at Entourage Effect Capital. Matt, thanks for being with us at the Talking Hedge.
You bet. Thanks for having me, Josh.
So Entourage Effect Capital, you guys are investing in companies with a growth stage focus, although that's not only what you do, but focus on growth stage and positioned to scale ahead of federal legalization. So if we get into the way back machine, maybe you could tell us about your investment objectives and strategies and how that's adjusted over the last few years.
Sure. I like to say that we, as a firm, we have matured with the industry in terms of kind of where we're investing, like what life cycle of the company, you know, the sector. Because when we started this in 2014, there was really only startups that were available to us. And right now we have the ability to invest in companies that are a lot more mature because simply of where we are from a industry growth perspective. I mean, you've got companies now that are, you know, that you can actually put a multiple on EBITDA, for example, to value these companies. And back then you couldn't do that because it was all startup.
So let's dive into maybe some specifics of some companies you've invested over time. I think it'd be fun to tell me if you would invest today, if you had a chance to do it over again. Pulling out a couple of companies, they happen to both be tech companies. One is MJ Freeway, the other is BDS Analytics. I really like BDS Analytics because I like data. I like diving into it. I like seeing what other companies like Headset are doing. And really kind of pushing the industry forward in terms of knowing the unknown. MJ Freeway's had its own issues, all of the competitors in that space have had their own difficulties in trying to get seed to sale, trace and tracking implemented in every single state. It doesn't seem like there's been a clean rollout whatsoever. And so I believe some of your investments were plant touching companies. Were those the most interesting, or is the tech kind of more normalized? Pulling out those two examples of MJ Freeway, BDS Analytics, do you still like those investments? Where do you see them going? And how does that work in terms of your overall portfolio?
Sure. So recognize we're investing out of our third fund now. So fund one had like I said earlier, a very early stage footprint to it. But we also got in very early with a lot of the multi-state operators when they're still private. We were one of the few games in town for investing in not only ancillary companies, but plant touching businesses. We weren't afraid to do that back in 2014. And that obviously we were big beneficiaries of that to generate the returns that we did in fund one that were, you know, fantastic. And then in fund two, we started doing more, still plant touching, single state operations, a little bit of a California focus, but we did a lot of ancillary plays too, that included some of the technology plays that you referenced. I would say now in fund three, it's really all about building scale within as many sectors as we can in advance of something happening legislatively, whether it's, say, banking, some type of a quasi legalization at the federal level. But all of that is, we want to build that scale in advance of institutional capital coming into the game, because that's what we're all waiting for. And it's what we need. It's what the industry can't survive on the few capital providers that are in place, us included, to support this, 30, 40, $50 billion domestic industry. It's just not sustainable the way it is. I mean, these companies can continue to grow, step by step, but if they had access to some real firepower from, institutional capital's liquidity, this would be a different conversation we'd be having. So we're just trying to get to that point and generate the returns from that to the benefit of our shareholders.
Has there been an example? Because I think practice doesn't make perfect, failure does. Is there an example that you can give to where you learned a lot from something that didn't work out? Maybe you want to give the name, maybe you don't, but I'm sure there's an example of an investment that didn't go right, but that you are appreciative of because of what you learned. Is there any example that you can give?
Yeah, I mean, look, we're a venture capital firm. I mean, when you think about it, I mean, even though we're investing in later stage deals now, at the end of the day, this is still a nascent industry. Mm-hmm. And so by that and the fact that it's federally illegal, just makes it a venture capital type risk reward investment opportunity. So having said that, of course, there are going to be deals that don't work out. Venture capital deals, I mean, if you look at their portfolios, it's usually one or two companies that make up the entire return of their portfolio. Luckily, that's not the case with us, but of course, we're going to have some missteps. I think the biggest mistake that we've made to date that we don't do anymore is we spend an inordinate amount of time underwriting the management teams and making sure that they have track records of success and everything they've done thus far. I would say a couple of times in the heat of the moment back when we were in the heydays of 16 and 17, and I can't remember which those were when it was starting to get bad, but it's been bad for a while now. But but those days, there were a couple times where we probably didn't spend as much time underwriting the management team as we should have, and just fell in love with the concept, fell in love with the company, and that came back to bite us in the ass. And so that ain't going to happen again.
That sounds a lot like Mark Cuban's Voyager crypto Ponzi scheme he got into. Probably didn't do his due diligence, and so have you ramped up your due diligence? Is that essentially what you've like?
Yeah, we never really ramped it down. It's just I would say that we got comfortable with management before we do some of the things we do now, and I'll leave it at that.
Mm-hmm. Let's talk about some of the financial makeup in the industry and how that's kind of evolved over time as well. Like most notably, the debt issuance is currently at 55% of total capital raised. And that trend line is around 70% of cannabis capital raises. Why is debt at its highest in history?
Well, there's two reasons, I think. One is that it's one of the only games in town, and you can utilize your real estate asset base to take in these loans. Now, granted, the most of them are pretty high yield, but they're there. Secondly, operators aren't wanting to take equity capital at this point because valuations have come way down. So the valuations are squarely in the favor of capital now. And you're even seeing some of these real estate lenders that are getting warrants too. So they're benefiting, they're dipping, their toes in the water on the debt side, but they're also getting some participation in warrants. That's why we're lucky in that we've been in this business for as long as we have, because we can create our own deals. I mean, we know everybody in the industry that we really feel like we need to know, and if we don't know them, we can get introduced to them pretty quick. So as a result, we, and because of our, the strength of our portfolio, people, want us in their capital stack, which is I'm very, very proud of that. And because of our reputation does precede us, that is something that you can't ever, you can't discount that. And being able to have that kind of deal flow and to create your own opportunities in an environment like this is absolutely paramount.
Mm-hmm. You mentioned that it's the only game in town. Would you say that there's FOMO and there's investors willing to take anything they can get?
No, not at all. In fact, I would say quite the contrary. There's private capital that's available, and a lot of these capital aggregators on the real estate side are having some success raising that capital because they're not really touching the plant. And so they can get access to some other investors who may be more willing to do that, take a nice yield from that, and not have the risk of investing directly in something that's federally illegal. Whereas, because you're still not seeing, this isn't bank lending that's going on right now. This is private capital lending that's going on. But it's the same problem we have as equity investors in the deals, is that there's still just a limited universe of people that we can raise our capital from. There is, starting to get more. There's more interest being generated, I think, the family office level than there ever has been. But the macroeconomic climate that we're in right now, outside of cannabis, isn't helping matters either. So there's just a lot. There's a lot of, while there's on one hand, there's a lot of tailwinds for the industry. I think regulatorily, you're starting to kind of feel that a little bit. There's still significant headwinds when it comes to capital.
Mm-hmm. Looking at the secondary market, the public side, there's a lot of retail investors trying to get in on the speculation, but it moves mostly with the news. It's momentum.
That's right.
Stock.
That's exactly right. And it doesn't help matters, because what retail investors like to get in and out. And you've got thinly traded, low liquidity exchanges that are involved right now. And until we can get uplisted into the U.S. exchanges, the main ones, the NASDAQ or the New York Stock Exchange, we're going to have this problem. And that's going to require legislative change and being able to bring in institutional capital, and then we're off to the races. So we don't think it's that far away. It's likely in the hold period of our most recent two funds. And so we're just trying to do what we can to position ourselves for when that happens.
I'm taking a poll, Matt. So I got to ask you the question I'm asking everybody. What is it going to take for these individual equities to move independently from the news? How are they going to look at either the fundamentals of these individual companies rather than lumping them all into the same industry?
You got to have a different type of investor. Just do. You got to have institutional investors that are not scared to go through the peaks and valleys that we go through as an industry right now. Retail investors, they don't like that. They see a loss, it's like, shit, I got to get out of this. And so they take their loss and they move on. So that to me is the biggest issue. Putting consecutive quarters together one after the other isn't going to hurt either. So I would say that, especially the not the top tier MSOs. I mean, they need to do it too, but they're a little bit. Some of those are it's easier for them, but the large single state operators, the smaller multi-state operators, they need to do the same thing.
Mm-hmm. The sell side analysts, they started to reduce their revenue estimates for EBITDA margins for 2023. Do you think they factored in the margin pressures from declining wholesale prices coupled with the higher energy and fertilizer, nutrient, and other input costs?
I would hope so, but my guess is they probably didn't. But there's as I mentioned a second ago, the macroeconomic issues are very, very real for cannabis, just like they are for for other industries. So it's going to have an impact one way or the other.
Mm-hmm. SPACs have been interesting. Those IPOs fell way out of favor, but real estate has been a beneficiary of sector rotation in 2022. The Polaris Equity Fund, for example, they're just trucking along like 1% per month or whatever, which a lot of folks would probably love to have right now, as they're probably looking at negative 15 to 30% in their portfolio. Which cannabis subsectors are you still seeing attracting equity capital?
Well, there's not many. I mean, like I said, we don't pay attention to what others are doing. I mean, we really have our focus on what our pipeline is. We have our focus on which sectors we want to focus on. We have which companies we think we want to help build scale around, and that's our focus. It really doesn't. I'm not looking at the other investment firms to say, hey, what are you in right now? We need to get in on that. I mean, we don't have that kind of. I mean, you said FOMO. I'll use a FOMO here too. We don't. That's not how we operate. So we still are very, very bullish on getting in at these valuations in as many sectors as we can, investing in the leaders of those sectors.
Mm-hmm. Looking at some of the distressed assets, I can only imagine that the M&A activity is going to pick up substantially. Are you seeing that the West Coast or the legacy markets versus the more emerging markets on the East Coast are more prone for M&A, or do they have first mover advantages, take advantage of the acquisition?
Yeah, I think that let's just talk about California for a second. I think you know we made some progress with the cultivation tax going away, but it's still a regulatory morass in California, and until something changes legislatively in the state, it's going to continue to be that way. It's just too hard to operate a cannabis company in the state, and it drives me absolutely crazy when Sacramento continues to act this way. When if they would just be smart and reduce the tax burden on the legalized companies, they would almost automatically convert companies from the illicit or users from the buyers from the illicit market into the legalized one. And they'd make more money in the state. It just makes no sense to me whatsoever. But that's politics, and some of that's going on at the federal level too. I would say that there's going to be, but to answer your question more specifically, yes, there's going to be a lot of M&A activity in California. A lot of it's going to be distress related. You're seeing signs of that already with some of the bigger players. We're fortunate that we executed our three-way merger at State House and raised some capital around that. Our stock price isn't anywhere near what it should be, but that's okay because we're not selling, and we're in this for the long haul. So we're certainly going to be acquisitive as we go forward at State House, but there's still a lot of wood to chop in that state, and we're no different at State House.
Mm-hmm. The year-to-date merger and acquisition volume is down over 79% from 2021. Do you have any insights as to why?
Companies holding on for dear life because they don't want to be bought or sold for the bid ask spread is too high right now. I mean, it's like, and until it gets absolutely 100% dire straight ridden, it's probably going to continue to be that way. People are looking for bargains right now, and the companies that don't think they're a bargain but maybe really are probably kidding themselves. But that's my take on it.
What's your take on the Hexco Tilray M&A? Is that going to be the equivalent of AOL and Time Warner? They thought that was going to be accretive. They thought that was going to be a great deal, and it is absolutely
yeah.
Are these two zombies holding each other up?
I look. We pay such little attention to the Canadian markets because it's just not our focus. I mean, we all know that the California market is bigger than the entire Canadian market. So we just don't see that as an investment opportunity. I mean, look how much money Canopy's spending on a monthly basis. I don't even know if they're going to be a viable company before it's all said and done. So there's just, I mean, it's going to get uglier and uglier in Canada, and I wish it weren't the case, but it is.
Mm-hmm. What do you try and avoid at all costs? Are you avoiding Oklahoma and all of their licenses, Florida and the potential for mildew and mold? Are you avoiding flower touching companies? What are you avoiding? What industries or sectors or regions are you staying away from?
Well, I mean that's a tough one to answer because I've been consistent saying that there isn't a sector that we don't that if we can find the right operator that is already large enough that needs help to build scale from a capitalization standpoint, I mean, we want to have a conversation. Mm-hmm. And so I don't. It could be anything, any sector or any region that's out there. I will say this. A lot of our Fund 3 focus has been on single state operators across, the Midwest and even the Southeast and even in the Northeast that are looking to expand into other states via other licensing opportunities they have. That's attractive to us. But we still, by the same token, we invested in Hound Labs, which is the only market available THC breathalyzer that exists right now. And so, that was a step out for us a little bit, but we saw everything that we saw we liked. And so we decided to do it. Everything else has been, like I said, scale driven opportunities in Fund 3.
All right, Matt, what advice do you have for a company out there looking to raise capital and they don't know if they're going to look for an angel investor or, private equity, VC, whatever? What advice do you have for somebody who's just starting out?
Well, just to clarify, for someone that's starting a new company,
they have a company, they have revenues, and they're just starting their just starting the
Series
process
A.
just starting the process of raising capital.
I always say there's nothing wrong with going to all the the cannabis funds that are out there. I always say it's so much better to do the legwork on the front end to try to get a warm introduction to those firms. I mean, we all see an inordinate amount of deals, on a daily, weekly, monthly basis. If you just send us all, messages via LinkedIn, that they go into file 13. So you got to do your legwork to see if there's a way that, use LinkedIn for what it is, which is see if there's a common connection and reach out to those people to see if they actually really do, know the investor. That's so much better than trying to come in cold. So trying to get warm intros is the first thing. The second thing is, if you have a friend or a family member that can truly be an angel for you, that's the best thing to do. Because with valuations the way they are, someone that that has a pocketbook that can help you, grow your business, that's by far and away the best thing to do. Because it's not easy to raise money right now at all in cannabis. And so it's going to be that way for the foreseeable future, unfortunately.
When a deck comes through and you see it and there's some crazy arbitrary valuation, like PAX had a $420 million valuation, is that something you try to negotiate, or do you just see it and say, next? Is there room for negotiation, essentially? If people put something in there you don't like, is it the end of the conversation, or is there wiggle room for negotiation?
Well, it depends on if they're looking to us to lead the round. If they haven't raised any capital yet, and that's their ask, well, of course we're going to negotiate it, because there isn't, we're in the driver's seat. There's not much capital out there, and we have capital. And so of course we're going to negotiate that. But if some other group or investor put in money already and they're looking to round out their raise, it's just a pass for us, because we can't negotiate that if we think the valuation is crazy. So it just depends on, where we are in the process, where we are considered to be in the capital stack, et cetera.
What about the requirements for consideration? If somebody comes in with pre-revenue, they're not making any money, is that even in consideration at this point?
Again, it just depends on the deal. We are doing most of our deals are later stage. We own over 50% of the ArcView group, and so they do have a venture capital investing arm that we invest alongside unpromoted. So we do funnel most of our early stage stuff through that. But when we invested in Hound Labs, it was pre-revenue, but that was what we thought was a game-changing opportunity.
Okay. What about the crystal ball? What kind of opportunities are going to be out in the cannabis industry in 2023 and beyond? Is there anything you want to share about the future?
Yeah, there's going to be continued consolidation, continued separation from, the men from the boys, et cetera, all those, analogies you can use, because it's real, it's happening. The way the current construct doesn't benefit mom and pop license holders anywhere. And, if we're not careful, if we don't separate, we're all for social equity, don't get me wrong, but if we don't start to separate the business issues from social equity and legislate both at the same time, or at least have them go down similar paths, just quit trying to put them together, we're going to continue to have some, headbutting on why can't we get this done? Why can't we get this done? And it's frustrating. But that's politics for you.
So you said there's going to be a lot of consolidation, but the M&A volume is down significantly. So people are kind of on the sidelines. They don't want to get bought out at maybe lower valuations, or they don't know what to do. And so what's going to be the difference between the lack of M&A?
Well, I'll tell you exactly what it is. It's 2023 is right around the corner, and these companies are still burning cash. At some point, that cash is going to get so dire that they're not going to have a choice.
Mm-hmm.
So that's what's going to happen, is that when things get to the point to where, okay, we can't raise any more money, and it's basically a fire sale, and that's going to happen. It absolutely is.
Yeah, I'm with you 100% on that one. We've covered a lot, Matt. Is there anything else you want to cover at this point?
I don't think so. Enjoy talking to you.
If people want to learn more, whether it's other institutional investors that want to add to the assets under management, or if it's somebody who has the next greatest unicorn idea and they want to get a hold of you, where are you at? How can they get a hold of you?
Yeah, just Hawkins at eecpartners.com. And obviously you can go to our website at eecpartners.com and learn more about us. And I'm happy to engage.
And you're going to be speaking at MJ BizCon on the, I think 16th of November. I
believe that's right.
Vegas. You're going to be on a panel with a whole bunch of other folks, so should be really interesting to listen to. So if they're in Vegas, they can check that out as well. So we're going to put the links in the show notes.
We'll be in Benzinga too next month. So we're excited about all that.
Mm-hmm. Yeah, I think that's the 14th of September in Chicago, maybe.
Yep, that's right.
Okay. Good deal. So yeah, we'll put the links in the show notes for EntourageEffectCapital.com, as well as Matt's LinkedIn connection. You can bug him all you want. So I think with that, roll this one up. So I want to thank my guest, Matt Hawkins, founder, managing partner at Entourage Effect Capital. Matt, thanks again for being with us at the Talking Hedge.
You bet, Josh.
Appreciate it. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.